It begins with a seismic policy shift. The United States announces that it will cease all domestic car production and rely entirely on foreign manufacturers for automotive supply. The news spreads rapidly across global financial markets, business communities, and consumer networks. For decades, the U.S. auto industry has been a cornerstone of the economy, employing millions, supporting ancillary industries, and driving technological innovation. The sudden pivot toward complete import reliance sparks immediate questions about employment, trade balances, consumer prices, technological leadership, and the stability of financial markets. The first and most obvious impact is on employment. Millions of U.S. workers, including assembly line employees, engineers, designers, and factory support staff, suddenly face job displacement. Entire cities and regions historically dependent on automotive manufacturing, Detroit, Toledo, Louisville, and others, experience economic shock. Local economies contract as consumer spending declines, and service industries dependent on these workers see revenue drops. Stock markets for companies in industrial sectors, regional banks, and related service providers reflect anticipated downturns. Manufacturing sectors ripple with shock. Automotive suppliers producing components such as engines, transmissions, electronics, tires, and interiors are forced to either retool for other industries or shut down operations. Steel, aluminum, and plastics producers supplying the automotive industry experience sudden revenue declines. Companies previously aligned with domestic auto production face bankruptcies or consolidation. Stock valuations for suppliers, industrial manufacturers, and materials producers adjust sharply downward. Corporate strategy undergoes immediate disruption. Major U.S. automakers, Ford, General Motors, Stellantis, formerly Chrysler, and Tesla, must pivot entirely from manufacturing to distribution, marketing, and import logistics. Revenue streams dependent on domestic production collapse, while operational costs shift towards supply chain management and international coordination. Stock markets for these corporations reflect both short-term revenue loss and long-term uncertainty about strategic repositioning. Consumer markets react with a mixture of excitement and anxiety. Imported vehicles may offer advanced features, competitive pricing, or brand variety, but supply chain reliance introduces risk. Consumers face potential price volatility, longer delivery times, and limited after-sales support. Auto dealership networks adjust operations, merging, closing, or transforming into import-focused distribution centers. Stock valuations for large retail and auto distribution chains fluctuate in response to projected revenue changes. Trade balances are immediately affected. Reliance on imports increases the U.S. trade deficit dramatically. Dollars flow out of the country to foreign automakers, creating pressure on currency valuation and potentially contributing to inflationary trends. Stock markets for exporters and import-dependent industries adjust as investors anticipate changes in macroeconomic conditions. Transportation and logistics sectors experience rapid transformation. Importing every vehicle necessitates expanded port operations, increased trucking and rail transport, and enhanced warehousing capabilities. Companies involved in shipping, customs brokerage, and logistics benefit from increased demand, reflected in upward stock adjustments. However, initial investment in infrastructure and capacity expansion creates short-term market volatility. Energy markets adjust. Imported vehicles, depending on fuel type, influence gasoline, diesel, and electric consumption patterns. Electric vehicle imports may accelerate adoption of renewable energy infrastructure, while gasoline-powered imports affect demand for domestic fuel. Stock markets for energy producers, utilities, and alternative energy companies reflect changing consumption trends. Technological innovation experiences both acceleration and disruption. U.S.-based R&D in automotive technology, battery development, autonomous driving, AI integration, and safety systems is disrupted as domestic manufacturers reduce production capacity. Some technology-focused companies pivot to global partnerships or independent innovation labs. Stock valuations for tech suppliers and mobility-focused startups fluctuate based on their ability to adapt to the new import-driven ecosystem. Financial markets experience heightened volatility. Investors adjust portfolios as traditional automakers lose domestic manufacturing revenue, while logistics, port operators, and import-heavy corporations gain relative advantage. Volatility indices spike as analysts factor in both employment-related contraction and supply chain expansion. Stock indices reflect sectoral divergence rather than uniform market behavior. Corporate debt markets adjust to changing risk profiles. U.S. automakers facing revenue disruption may experience credit downgrades, while logistics and import infrastructure firms enjoy improved access to capital. Stock markets for banks, credit rating agencies, and bond insurers reflect the reallocation of risk across industries. Labor markets are strained but partially reallocated. Factory workers may transition to roles in logistics, import management, or alternative manufacturing sectors. Retraining programs accelerate, though not all displaced employees are absorbed quickly. Stock markets factor in potential reductions in consumer spending and economic productivity, as labor transitions lag behind structural change. Consumer finance markets experience adjustment. Auto loans previously tied to domestic sales must adapt to imported vehicles and potentially higher costs. Interest rates, loan terms, and default risk are reassessed by banks and financial institutions. Stock valuations for consumer finance companies fluctuate as auto financing patterns change. Housing markets and manufacturing regions suffer. Cities historically reliant on automotive employment see reduced property demand, lower home prices, and slower construction activity. Real estate investment trusts, REITs, with exposure to these areas adjust valuations downward, reflecting reduced rental income and property appreciation potential. Corporate supply chains undergo a massive realignment. Components traditionally sourced domestically are now imported as part of fully assembled vehicles or global supply kits. Supplier companies either pivot to alternative industries, merge, or exit the market. Stock valuations for suppliers in metals, electronics, plastics, and specialized components fluctuate with restructuring success. International trade relations are reshaped. U.S. reliance on foreign automotive manufacturers strengthens economic ties with countries such as Japan, Germany, South Korea, and China. Geopolitical risk becomes a factor for import-dependent operations. Stock markets respond to both opportunity in global partnerships and potential risk from international tension or tariffs. Environmental policy and emission standards face complex challenges. Imported vehicles must comply with U.S. safety and environmental regulations, necessitating oversight and potential adjustments to international manufacturing processes. Stock valuations for compliance service providers and regulatory tech firms adjust as new demand emerges. Consumer behavior shifts. U.S. buyers adapt to international brands, varying quality standards, and differences in warranty or service networks. The perception of foreign-made vehicles affects purchasing patterns, influencing revenue for dealerships and manufacturers. Stock markets for consumer discretionary sectors reflect changing consumer confidence and brand loyalty dynamics. Corporate mergers, acquisitions, and strategic partnerships accelerate. U.S. automakers form alliances with foreign manufacturers to maintain market presence. Stock prices for collaborative ventures reflect anticipated synergies and revenue stabilization. Meanwhile, domestic suppliers unable to pivot face acquisition or closure, with stock valuations reflecting sector consolidation. Tax revenue from manufacturing declines. Federal and state governments experience reduced corporate income and payroll tax collection. Economic contraction in manufacturing regions affects property taxes, sales taxes, and local revenues. Stock valuations for municipal bonds and regionally exposed financial instruments adjust to potential fiscal stress. Small and medium-sized enterprises and automotive ecosystems face acute disruption. Component manufacturers, specialized service providers, and regional logistics firms lose contracts, forcing layoffs or business closure. Stock prices for publicly traded suppliers and industrial service providers reflect heightened risk exposure. Energy and infrastructure sectors experience opportunity and challenge. Expanded imports require increased port capacity, warehousing, and transportation infrastructure. Utilities adapt to changing fuel consumption patterns. Stock markets for infrastructure, energy, and construction companies adjust to potential growth opportunities alongside increased capital expenditure requirements. Financial institutions recalibrate risk exposure. Loans to manufacturers, suppliers, and logistics companies are reassessed. Consumer credit exposure changes due to altered auto loan patterns. Stock prices for banks, credit unions, and financial services reflect adjusted risk assessments. Consumer inflationary pressures arise. Imported vehicles may carry higher tariffs, shipping costs, or currency risk, which are partially passed on to consumers. Retailers and dealerships adjust pricing, while consumer spending patterns shift in response to affordability. Stock valuations for retail and consumer-focused companies reflect potential demand reduction. Corporate innovation pipelines are disrupted but partially redirected. Research into U.S.-based production technology, robotics, and automation is deprioritized, while investment shifts toward distribution efficiency, international partnerships, and aftermarket services. Stock valuations for technology and innovation-focused firms reflect both contraction in manufacturing-driven growth and potential gains in logistics and service innovation. Global markets respond to U.S. dependence on imported vehicles. Foreign automotive manufacturers experience increased market share in the U.S., while geopolitical factors, currency risk, and trade agreements influence pricing and supply reliability. Stock markets for global automotive firms react positively to increased access and demand. Employment in retail and aftermarket services adjusts. Dealerships, repair shops, and service providers adapt to imported vehicles, requiring retraining or investment in parts supply networks. Stock valuations for automotive services reflect adaptation speed and market penetration. Consumer confidence fluctuates in response to supply chain reliability, pricing, and domestic employment trends. Stock markets for consumer-facing sectors, particularly discretionary spending, adjust based on projected purchasing behavior. Corporate debt markets reflect structural changes. Companies with revenue loss due to the cessation of domestic production may face debt service challenges. Conversely, logistics and import-related firms experience improved access to financing. Stock valuations for bond markets, banks, and lenders adjust to reallocated risk. Trade-related geopolitical risk increases. U.S. dependence on foreign automotive supply makes the economy sensitive to political developments abroad, tariffs, or sanctions. Stock markets incorporate potential disruptions and international policy risk into valuations. Technology adoption and workforce retraining accelerate. Automation, AI-driven logistics, and import management systems expand. Companies investing in digital infrastructure gain long-term efficiency. Stock markets reflect anticipated productivity improvements in logistics and supply chain management sectors. Consumer markets diversify. Buyers explore different vehicle types, including EVs, hybrids, and imported gasoline-powered cars. Stock prices for alternative energy, EV infrastructure, and international automotive brands reflect shifting consumer trends. Corporate mergers and acquisitions continue to reshape the industry. U.S. automakers form strategic alliances, joint ventures, or divest manufacturing assets entirely. Stock markets react to both risk reduction and potential opportunity in global partnerships. Supply chain resilience becomes a central strategic focus. Companies diversify sourcing for components, invest in contingency logistics, and optimize inventory management. Stock prices for firms demonstrating adaptability reflect market confidence in long-term operational stability. Financial markets remain volatile in the short term, but stabilize as the economy adjusts to import reliance. Investors weigh growth opportunities in logistics, infrastructure, and international partnerships against risks in employment loss, inflation, and domestic industrial contraction. Long-term economic effects emerge. Regions previously reliant on automotive manufacturing experience slower growth, while logistics hubs, port cities, and import distribution centers expand. Stock markets reflect regional economic shifts and sectoral reallocation of resources. Corporate innovation focuses on distribution, supply chain optimization, and aftermarket services. Firms invest in technology to improve efficiency, reduce costs, and maintain profitability. Stock valuations reflect growth potential in adaptation-driven sectors. Global trade relationships deepen with countries supplying vehicles. Bilateral agreements, currency hedging, and strategic supply contracts influence market stability. Stock markets for U.S. investors reflect exposure to international partnerships and geopolitical considerations. Consumer behavior evolves. Demand for vehicles remains robust, but preferences shift toward brands offering reliability, service networks, and competitive pricing. Stock prices for dealerships and import-focused retail networks reflect market adaptation to consumer expectations. Investment capital reallocates towards sectors benefiting from import reliance. Logistics, port infrastructure, supply chain technology, and international trade services see capital inflows. Stock valuations in these sectors rise relative to traditional manufacturing and industrial stocks. The scenario underscores the systemic impact of ceasing domestic car production. Employment, regional economies, corporate strategy, trade, technology, consumer behavior, and stock markets all experience profound transformation. Companies capable of adapting supply chains, investing in logistics, and leveraging international partnerships may gain market share and stabilize revenues. Ultimately, the U.S. economy transitions from domestic automotive production to an import-driven ecosystem. Stock markets adjust to reflect sectoral realignment, trade dependency, innovation in logistics and distribution, and the long-term consequences of reduced domestic manufacturing.